Welcome back. We're watching Commodity Champions. I'm Anisha Gupta. And what will 2023 look like for the commodity space? What are the key events to look at while planning your portfolio? To answer all of these questions, I am now joined by Edward Morse, Managing Director and Head of Commodities Research at Citi. Ed, hi, such a pleasure to have you. I want to start asking you about the price view that you would have on the energy space. So whether it's about crude oil or natural gas, what's your sense on these?
Well, we think that they're going to remain volatile, maybe not quite as volatile as last year, but still volatile on a short-term basis. And that is a result of several factors. The first one, I would say, is a significant lack of liquidity in futures and options markets, which means that we see sell-offs, we see buying that's very erratic, and we can have one or two firms enter the market in a big way if they have a big position for themselves and there's not enough liquidity to absorb whether they're selling or whether they're buying. And we then see prices going down by $5 or more or up $5 or more. We don't see that changing anytime soon. The second factor involved in the volatility is, of course, the really significant lack of inventories in the world, so that when we have seasonal changes, and we have changes that are impacted, especially by weather, we have a greater volatility because of a lack of cushions that are in the market. And a third factor is the weather itself, and that's because ever since the late 1990s, ever since the late 2019, 2020 period, we've seen the global gas market become a global market. It used to be a fragmented market. It was fragmented in part because underlying gas is an inability or an expense of transporting it from one place to another. Even more restrictive were destination restrictions that were imposed in most of the first 3 decades of LNG. And that's because these projects are so expensive in terms of both liquefaction capital required and regasification capital required. And then enter the United States, which by the end of the last decade became the largest LNG exporting country in the world. And the US has rules against destination restrictions, which has allowed natural gas to move from one place to another on a spot basis whenever there is a shortage one place or another. So we will have undoubtedly weather affecting the natural gas markets far more than affecting other markets, and they'll be rippling around the world. If we have a polar vortex in Europe, for example, we can see current prices, which are in terms of dollars per million BTUs, around 6 or 5 in the United States, and around 23 or so and 25 in Europe, and a little over 30 in the Asian markets at the moment. The European market is getting tighter with colder weather. If we have a polar vortex, we could see on a BTU basis, gas going up to $60 per million BTUs or even higher, 10 times where they were at the beginning of 2021, 3 times or so higher than now. And we think there'll be much more volatility in the gas markets.
Oh, clearly, crude and gas both continue to be quite volatile, but we understand those ranges that you've told us. I also want to talk to you about the gold prices, which in the last quarter of the year have seen a bit of a rebound. Would you advise allocating funds for this in the new year? And what's your sense on prices?
We actually think that when we get to an easing of central bank tightening, then gold will see its day. And the increase we saw when gold reverted back above $1,800 an ounce not so long ago, that coincided with a fall in the value of the US dollar. DXY went from about 110 to an index of around 102. And then the Federal Reserve Bank, despite the skeptics who said they were going to slow down rate increases, did not do that. And we don't think they're going to slow down until they get to a higher level. So we think gold will be bouncy until the central bank, and particularly the US central bank, slows down and stops its rate increases, at which point we think gold will be on a rebound, and we think that gold will likely exceed the $1,900 an ounce level by the end of the year and higher than that in 2024.
Okay. So gold prices can stay around $1,800 per ounce. But what about silver? Because this has seen a big range as well. Do you see industrial demand support prices in the new year?
Well, silver is kind of funny. It's neither a pure industrial metal nor a pure precious metal substitute for gold. So it responds both to the way gold is responding and it responds to industrial production. We don't see any massive increase in industrial production in Europe. We see a continued slowdown of it in the US. The two stars of the world in terms of growth of industrial demand in the year might be in Asia, might be China and India, but in China, the rebound is not going to be in the first quarter. There are too many headwinds, including the continued evidence of COVID itself ramping up, even as the lockdowns are easing. So to the degree there would be an industrial rebound, it's likely to be the latter part of the year rather than before then, and more likely to be, as I said, in East and South Asia than in either Europe or North America.
All right, at least there is some hope in the second half of next year. Also, steel and iron ore prices have seen support on China's stimulus injections. Your sense on all of these commodities in 2023?
Well, sense on commodities in 2023 is going to be very divergent from one another. We think that unlike some others, that we're not entering a commodity super cycle. We think unlike others, the evidence is overwhelming that the cost structure of the industry for oil and gas is such that even at these prices, there's an encouragement of a new investment. We think the new investment is adequate. You mentioned iron ore, where we've raised our prices recently. That has to do in particular with the status of inventories around the world. China's starting to ramp up a little bit on its industrial production. So we've raised our price outlook for iron ore, getting above $148 a ton in the interim, maybe going even higher. But given the cost of extracting iron ore, we expect that by the end of the year, iron ore prices will level off and get back down to the $100 range. When we look at industrial metals, we are actually on the short side for the short term and on the long side for the long term. We've seen adequate inventories in China with their own slowdown. We've seen lack of demand in the short run. We've seen financial flows into the market that have recently raised the price of not of all, but most metals. We think they raised the price to a level that's not not really realistic in terms of the supply-demand balances today. On the other hand, while we expect prices to come down from their highs in the first quarter, we do think that by the end of the year, we think most industrial metals, with perhaps the exception of aluminum, will be on the rebound. And indeed, we are very positive on most industrial metals, particularly the metals that have an important role to play in battery power. And that includes copper and aluminum eventually for purposes of wiring in a world in which electric vehicles and electrification in general and the distribution of electricity are becoming more important. But we have nickel and we have cobalt and manganese and other battery metals, including lithium. Lithium may be the one exception where the demand is hitting the marginal price at the end of the supply curve, and the prices will go up. And we've really seen an inadequate amount of investment on the metal side. I say the big exception is lithium, where prices have gone up a significant amount over the last year, but the cost of extracting lithium is a tiny fraction of the price in the marketplace, maybe 1/10 of it at the moment on average. And that suggests that as more lithium is brought into the market, the price will have much more downward pressure, unique among the battery metals.
Fair point. But Ed, among the base material prices, the best bullish bet clearly continues to come in case of copper. What kind of demand supply scenario do you envision here?
Well, we envisage a supply and demand scenario where the price of copper at the margin will grow above 9,000 and hit $10,000 a ton before long. So it's really looking at where we think demand is coming from and what a supply curve is telling us.
All right. That's a lot of non-agro commodities, but I do want to talk about the soft commodities. And this was a year of highs and immense profits. What's your best bet, or what catches your eye for 2023 within softs?
Well, it depends on what we're looking at. What catches our eye initially is that when we look at the grains complex, that the world was caught in a tight market when the Russia-Ukraine conflict started. And then there were concerns about everything from fertilizer and where it's going to come from to what if there is a disruption of grain exports, corn and wheat from Ukraine, and that falling into a shortage in Russia, and what the impacts for that going to be on emerging market countries dependent upon those Russian and Ukrainian exports. And then we had bad weather in Brazil, bad weather in the United States. But as you know, and we had one other thing, we had countries, including India, that put a ban on the exports of softs in particular in order to preserve a lower price in a domestic market. But a lot of that is easing, particularly on the grain side. A little bit more complicated when it comes to the other softs, when it comes to sugar and coffee and cocoa and the like. But still we see, as a result of higher prices, more acreage under cultivation seasonally in both Latin America and Australia and other parts of the Southern Hemisphere, and then followed by more acreage under cultivation in the Northern Hemisphere. Undoubtedly, we don't know the level of drought in the future. Brazil has come out of its drought. The mid-continent of the U.S. has come out of its drought, and Europe has come out of its drought. So the weather looks more favorable, and we think the prospects are, for most softs, neutral to bearish.
All right, that's good news, at least from the food inflation part of it, that most soft commodities could be looking at neutral to bearish cues coming in for 2023. Ed Morse, always a pleasure talking to you. Thank you so much for joining us with your sense on all of those commodities. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.